Saturday, March 23rd, 2019, Maneco 64, home of alternative economics and contrarian views. So this morning I want to talk about the bond market and how the economy, not only in the US, but all around the world, the world major economies seem to be unraveling all at the same time and very quickly. Some of you might know that I worked as a futures and options broker for over 20 years in the city of London. And the major markets that I covered were bond markets. So what I saw yesterday is worrying, and that's why I want to talk about it. And the repercussions for what happened yesterday. I'm going to talk about what the repercussions are for the economy, for precious metals. Before that, I'd like to thank everyone for their support, all the new subscribers. And if you do want to support the channel in any other way, you can go to my store, the maneco 64 Teespring store. I've got End of Fed mugs, I've got Billy mugs, I've got t-shirts, sweatshirts. And you can also, if you think the channel adds value, you can think about donating via PayPal or Patreon or any other way. I've got cryptocurrency wallet addresses if you'd like to do that. So yeah, yesterday, well, the whole week was very interesting because first we saw the Fed on Wednesday backtrack completely and say they're not going to raise rates anymore this year. They're going to stop unwinding their balance sheets. And what unwinding their balance sheet means is basically raising rates because they're not going out there and repurchasing assets that went off their books. And when they repurchase assets, they're actually printing money and putting it into the banking system. So by shrinking their balance sheet, they're actually taking money out of the banking system and the economy. So they've reversed that. I mean, I've spoken about this, that only a couple of months ago, Goldman Sachs and other banks on Wall Street were saying that the Fed was going to raise 3 or 4 times rates this year, and that the balance sheet unwind was going to keep going, that it was going to get down maybe to 3 trillion, maybe less. Well, they're going to stop, when they stop in September, is going to be around 3.9 trillion. So the initial reaction after the Fed announced this on Wednesday was that stock markets actually rallied a little bit. I was looking at it, but then they finished the day, the Dow finished the day down about 140. I think the 10-year yield dropped to around 253. So there's a major, the major bid in the bond markets. You need to understand that when yields drop in the bonds, that means that prices go up. And then the next day on Thursday, I don't know what happened. Some people, I said it could have been the PPT, but everything reversed. The dollar rallied, the stock market rebounded 200 points, and the bond market stabilized. But then yesterday, everything reversed. And I remember in the city, in the markets, we used to talk about kind of a rule of thumb that when you had economic statistics come out, and these statistics, usually the major economists, analysts, they make forecasts. So we're always looking for expectation. And then when the number comes out, if it's within expectation, the market doesn't do much. And then if the number is higher than expected or lower than expected, you can see a big move in the market. And the rule of thumb was that the initial reaction of the market to the economic numbers or the announcement from central banks as well was that was the initial move of the market would be the move for the market in the short to medium term. So that's how the market would continue going for the next few days or weeks. So I found it quite strange what the market did on Thursday, and I'm not surprised, I guess. what happened yesterday, because all of that was reversed. We saw the Dow finish down 460, 1.77%. We saw the S&P finish down 54 points, almost 2% lower. And the NASDAQ finished down almost 200 points, 196, or 2.5% lower. So what drove that yesterday? I think there's a few things. We try to find, I guess, justifications for market moves, and maybe that's not a good thing. But I saw that there's a very weak German PMI, Purchasing Managers Index, manufacturing sector. And we all know that Germany is a huge manufacturing powerhouse, and that number was expected at 48, and it came out at 44.7. And that's when yesterday morning, right after I did my video, everything started moving lower, because when I did my video yesterday, the stock market was virtually unchanged, and then it just started falling out of bed, and it was after this number. Well, the PMI is basically a survey of purchasing managers in the manufacturing sector, and usually when that number is at 50, it means that the sector is stable. Above 50, it's expanding, and below 50, it's contracting. So we know as well that the ECB has thrown the towel a few weeks ago. Mario Draghi, ECB president, also, they've given up on raising rates this year. They're probably going to only raise it, if they do, next year. They reinstated the LTRO, which is basically cheap loans to the banks. It's not QE, but it's still a program there of cheap loans. And now the Fed. So you can bet all the other central banks in the world are not going to be moving that much. If anything, they're going to reverse. If they've been raising rates, they're going to reverse it. And I think this is worldwide. I mean, I've made a few videos in the last few weeks about how the economy is slowing down. I made one on March 2nd. And it's entitled U.S. Economy Running on Fumes as GDP Forecasts Plummet Below 1%. And this was Goldman Sachs, the New York Fed, the Atlanta Fed. They're all saying this. So you just need to keep an eye on these things. And these people tell you sometimes what things are, what they think. So yesterday, I mean, you look at the what the 10-year yields did all across the world. And you can see here that in the United States, the 10-year yield dropped 10 basis points in one day. That's pretty big, especially when rates are relatively low as they are. So it dropped to 244. In Canada, it dropped 7. Brazil, I'm not sure. I don't follow that market. It's up 32. I don't know what happened there. But Mexico was down 4. And then you look at Europe. I mean, the German Bund, the 10-year Bund, which is the German government bond, that dropped 6 basis points and is now back in negative territory. I think it was negative about 3 years ago, but it's now, you're paying the German government to lend money to them. In the UK, where inflation or the cost of living is probably running at 5 to 10%, we only get 1% for lending money to the UK government. It dropped 5 basis points. In France, where the yellow vests are still protesting, it dropped 5 basis points. Even in Italy, it dropped 1. Spain, Netherlands, all across the world. Australia, New Zealand, Japan, of course. So this is a world phenomenon. And what about the yield curve? Well, that also inverted for the first time since 2007. It inverted from 3-month to the 10-year. So right now, as you can see here, the US 3-month yield is at 245. And the 10-year is at 244 roughly. So that's 1 basis point, but it did invert, and I think it was even around 5 or 6 yesterday at one point. So it kind of stabilized towards the end of the day. And why is that important? Well, here's an article from Zero Hedge. Yield curve inverts for the first time since 2007. Recession countdown begins. And it says the most prescient recession indicator, the market just inverted for the first time since 2007. Don't believe us? Here's Larry Kudlow last summer explaining that everyone freaking out about the 2's10 spread is silly. They focus on the 3-month to 10-year spread that has preceded every recession in the last 50 years, with few, if any, false positives. Larry Kudlow, of course, used to be an economist on CNBC. Now he's in the he's the head of the Council of Economic Advisors to the Trump administration. And he said last year, actually this is in July, he said, actually, we're reading the spread wrong. Larry Kudlow says of the flattening yield curve, there's no recession in sight right now. And they all go on to say, as we noted below, on 6 occasions over the past 50 years, when the 3-month yield exceeded that of the 10-year, so 3-month to 10-year, economic recession invariably followed, commencing on average 311 days after the initial signal. And here's Bloomberg showing how the yield curve inverted in 1989, 2000, and 2006, with recessions promptly starting in 1990, 2001, 2008. This time won't be different. So there you go. That's why it's important. What's this coming slowdown? I mean, you saw those years there, 1990, I guess there was a savings and loans crisis around that time, 2000, the dot-com bust, 2001, 2007, 2008, we know what happened, the great financial crisis. Will there be a great financial crisis now, or will it just be a really bad recession? I don't know. And what could be the main driver? I mean, in 2000, 2001 was the dot-com bubble. In 2007-8 was the housing bubble, the subprime bubble, or housing market bubble that Greenspan engineered. What is it going to be this time? Well, it could be the everything bubble, all financial assets. What could trigger it? It could be leverage loans that I've been talking about. It could be something that we're not even aware of right now, but Wall Street and the central bankers are aware of. There's another article, the Fed has given up, get ready for more QE, offered by Ryan McCacken via the Mises Institute. I haven't read that article, but I've seen that headline. It's not going to make anything better. I think the lower rates and even negative rates actually they're bad for the economy. We have the baby boomers retiring, and we've got zero rates, negative interest rates. It's the biggest retirement in world history. Not only in the US, but in Europe. These people are asset rich, some of them, but they can't get an income on their assets or their portfolio, or their savings or pensions, whatever you want to call it. They're not going to do well. And the banks are not going to do well as well. Banks do well from borrowing short term and lending long, and usually the short-term rates are low and the long-term rates are higher, and they make that spread. And we know in this credit-driven economy, the banks are the engine, unfortunately, for the economy. So what do you do in this scenario? As I've been saying, and this is not advice, but it's what I've been doing for the last 10-15 years, dollar cost averaging precious metals, physical gold and physical silver. And in the world of negative interest rates, NERP, and even some in the US are saying that might go to negative interest rates for the Federal Reserve. That is possible. It depends on how bad this coming recession or crisis could be. with gold being a risk-free credit asset, as the Bank for International Settlement says, it's just as good as cash in the bank, physical gold. It's not, it doesn't have a yield, so it's zero. So when an asset yields zero, it's better to have that. And if that asset is just as good as cash in the bank, and cash in the bank is giving you a 1 or 2% negative interest rates, which one would you hold? Yeah, so there you go. For those viewers in the UK and Europe who are interested in precious metals, I have a promo code with goldinvestments.co.uk. They're arguably one of the oldest bullion dealers in the City of London. The promo code is maneco64, and you get a 0.5% discount when you purchase gold or silver with them. All right, so very interesting week, and I think it's a week that is very important in terms of marking a really important event, when the Fed succumbed, when the bond market flashed warnings, and that was a warning this week, especially yesterday, the bond markets. If you enjoyed this video, make sure you hit the like button. Subscribe to the channel if you haven't yet, and if you enjoyed the videos, why not? Make sure you share my videos far and wide if you think other people might enjoy it. And you can also follow me on Twitter, Steemit, and DTube. I wish you all a great day and weekend. I'll talk to you later. Take care. Bye.